do you have access? You have no account. Okay. Okay. Does can is it not possible to get an account for you, or are you the only student who doesn't have an account, or do you know what's the reason? You don't know. Okay. All right. I will ask the university whether they can get you an account. But for now, I can of course send you the slides. And so now I have sent you an email with the slides. Probably. If you have not gotten them, and they will come in soon. So let's go on. So what is a financial statement, and how is it produced, basically? This is this slide about, and in financial statements, actually, it starts with business transaction. And what is a business transaction? It is basically basically everything. Yeah, everything. Every transaction in a company is a business transaction. So, for example, when BMW is, we talked about BMW before, when BMW is buying a machine, yeah, that is a business transaction. And or when BMW is selling a car, yeah, this is a business transaction. And then it's recorded in accounting system. And those accounting systems, they produce the financial statements. Financial accounting is about preparing the following financial statements. The income statement. Income statement is, as I said, about revenues and expenses. Yeah, we have also the statement of comprehensive income, which is a more, as the word says, actually, it's a more comprehensive income. It's not only the net income, which is the earnings of a company, but also additional income. Yeah, and we have the balance sheet. Sometimes the balance sheet is also called statement of financial position. Yeah, and the balance sheet is about the assets and the liabilities of a company. So this is what the company owns and what it owes. Yeah, about the assets and liabilities. Assets and liabilities. Statement of cash flow. This is about cash in flows, cash inflows, and cash outflows. Cash inflows and cash outflows. Cash inflows and outflows. And we have a statement which is not as well known as the other statements. It's a statement of changes in equity. This is basically as a statement that shows how equity changes from one year to the other. Yeah, equity, as I said, is assets minus liabilities equals equity. Yeah, and then we have the notes. Any idea? Do you know what the notes to the financial statements, what they are about? The notes are there to explain. Yeah, to explain what is in the financial statements. They explain what is in the income statement, what is shown in the balance sheet, and so on. So this is obviously this is a map of the world, and this map is about the adoption of IFRS. So all the blue countries, they have adopted IFRS. The black countries, they have not adopted IFRS. So basically, mostly they have their own standards. Yeah. So IFRS, what does IFRS stand for? Do you remember? What does IFRS stand for? International Financial Reporting Standards. Yeah, this is correct. So it should be international. This is the intention, and it is international. You see that basically most of the countries are blue. Yeah, so most of the countries are blue, and they have adopted IFRS. There are some countries that have not. Yeah, for example, India doesn't have IFRS, or the United States, they also do not have IFRS. The United States have their own standards, and they are called US GAAP. Yeah, but in 2002, so about, what is it, 18 years ago, the IASB, which is the body, the standard setter for IFRS, they signed a treaty with the FASB, which is the standard setter for US standards. They signed a treaty, and they agreed that they want to converge the two systems. So basically what that means is that they want it to make more and more the same. So basically, when you read a financial statements of a company that is based in the United States, you will understand them when you know IFRS. So when you read the financial statements of, I don't know, let's say Amazon or of Google or whatever US-based company, then you will understand them when you know IFRS, because IFRS is so similar to the US standards, that are called US GAAP. So very, very, very similar. Yeah. This is here the objective of IFRS. IASB says the objective of IFRS is to develop a single set of high quality, understandable, enforceable, and globally accepted financial reporting standards based upon clearly articulated principles. Yeah. So what are the main points? High quality, of course. Yeah. Nobody wants something of poor quality. They wanted to be high quality. They wanted to be understandable. Why understandable? Because basically accounting is the language of business, and when you want to have a language, you want it to be understandable. Yeah, of course, because you want the other party to understand the rules. Enforceable, yeah, of course, should be enforced by the companies, and globally accepted. Yeah, and this is truly the case. What we just saw it, that it is really globally, internationally accepted in pretty much all of the world. Here we see the differences between IFRS and HGB. HGB is the old German standards. Yeah, and there is a difference between IFRS and HGB. HGB was very conservative. Yeah, the Germans' rules were very conservative, and the purpose was the protection of creditors. Yeah, because in Germany, traditionally, banks play a big role, and the standards want to protect those banks. In IFRS, it's different. The purpose of IFRS is to inform investors, and investors means basically shareholders, equity investors. So the main addressees are investors, shareholders for IFRS. IFRS wants to inform investors, and HGB wants to inform the creditors. Yeah, the creditors are banks, investors are shareholders. And objective of IFRS: provide information about financial position, performance, and changes in financial position. In HGB, it's more about the assessment of payment, assessment of tax obligation. The report situation in IFRS, we want really to report the fair, true and fair value. Yeah, and true and fair value means we want that the value is presented realistically. Yeah. Realistic. In HGB, which is the old German rules, they say it's according to GOB. The GOB are actually the framework, more or less, for HGB, and this is more conservative, on the conservative side. Yeah, so HGB is much more conservative. They want businesses to be much more conservative in their reporting, which means understate the assets and overstate the liabilities, basically. Yeah. The legal system in IFRS is case law. Case law is the legal system how we have it in the Anglo-Saxon world. This is the United States, Great Britain, and Australia. They all have case law, and case law means that we have a low level of abstraction. In HGB, we have code law, which means a high level of abstraction. Case law is basically, it means case law because there is a rule for every case. Yeah, that's why it's called case law. For every case. Influence on taxes. In IFRS, there is no influence. I already said, yeah, there are different rules for tax calculation. In HGB, the situation is a little bit different. We have the Maßgeblichkeitsprinzip, how we call it in Germany, and that means that the financial statements are relevant for the taxes. Yeah, income in HGB we only have the income statement. In IFRS we have income statement and other comprehensive income. Income statement and other comprehensive income. That's why it's also called a dirty surplus accounting. Yeah. Why dirty surplus accounting? Because not every euro or whatever currency you have does flow through the income statement. Yeah, there is some that go through other comprehensive income. Yeah, the dirty surplus. Dirty surplus accounting. in what is the purpose of the framework? Yeah, let's go back to IFRS. What is the purpose of the framework? The framework lays out the foundation for the rest of the standards. It's kind of like it's not an accounting standard. It's more like the theoretical background. Yeah, and also it's when there is no standard for something, yeah, we want to know something and there is no standard, then you can go back to the framework. Yeah. And it helps to assist the standard setter. Yeah. Do you remember what the standard setter, how is it called? Standard setter is the IASB. It helps to assist preparers and the auditors. So what are the elements of financial statements? We have assets. Assets are economic resources. How would you describe an asset? Yeah, right. What the share owners own. That's correct. Yeah. No. Asset. What the share owners own. Liabilities are present obligations. Present obligations. How would you describe a liability? Assets are what share owners own, and what are liabilities? Yeah, what the share owners owe to others. Yeah. What share owners owe. Owe to others. Equity is the residual interest in assets when deducting liabilities. Yeah, so here we have what is important. We have the accounting equations, and the accounting equation means assets equals equity plus liabilities, and you can transform it. Yeah, to put it the other way around, and then you have equity equals assets minus liabilities. Yeah, so this is the accounting equation, and you can transform it. It has always been it will always have to be, it always has to be in balance. This is the accounting equation. Yeah. Accounting. Income is an increase in equity which does not come from share owners. Can you think of an increase in equity that comes from share owners? Here, this income is an increase in equity which does not come from share owners. That's income. Which increase in equity does come from share owners? What is the opposite? Yeah, profit equals income minus expenses. This is correct. It can also an increase in equity can also come from an IPO, for example. Yeah, we talked about IPOs before, and an IPO is also an increase in equity, but this comes from the outside. This is a transaction from the outside. When you have income, this is also an increase in equity, but it does not come from the outside, but from within the company. Yeah. Then we have expenses, and expense is a decrease in equity not going to share owners. Yeah. Sometimes decreases in equity also goes to share owners. For example, in the case of a dividend. Yeah, when the company pays a dividend, it goes to share owners. Yeah. But expenses are decrease in equity but are not going to share owners. Yeah. And we have the profit, which is income minus expense. Here we have the income statement in more detail. We have the expenses, and we have on the other side we have sales, we have revenue, and we have other income items. Yeah, other income can be other operating income or finance income. Yeah, finance income, financial income can be, for example, this can be dividends received. Yeah, for example, dividends received. When you deduct the left-hand side from the right-hand side, you have net income or net profit. Yeah, the statement of profit or loss or the income statement is often the first statement in an annual report. Yeah. This, the net income or net profit, is also often called the bottom line. The bottom line, because it is the bottom line. Because it's the last line of the income statement. That's why Sometimes it's called the bottom line. Can expenses also exceed revenues? And how is that called when expenses exceed revenues? Then it's called a loss. It's called a loss. The bottom line is then called a loss if expenses exceed revenues. So generally, revenues cause equity to increase, and expenses cause equity to decrease. What is important here is that the income statement shows the performance for a given period. Yeah, it's not about a point in time. It's not about a snapshot, as with the balance sheet. The balance sheet is about a snapshot in time, about the 31st of December, for example. But the income statement is about a period. It's for a period. Yeah. So this is different, and that's why you read in an income statement. When you look at an income statement, you read for the period ended. Yeah, you do not read at 31st of December. This is because it is not at 31st of December. It's for the period ended. Yeah, so it is. For a period. This is how the income statement looks in more detail. We have on the income side of the balance sheet, we have revenues. This is when. Can you give me an example of a revenue? Of sales revenue? Can you give an example? What is revenue? Yeah, Ray says all the money I get in transaction. It's the transaction. It's the core business. Yeah, when a company is selling, for example, let's say when BMW is selling cars, this is revenue. Why? Because BMW's core business is selling cars. When, for example, let's say Nestle is selling chocolate, yeah, or coffee, because the core business of Nestle is selling chocolate or coffee. Then we have other income. Other income is income that is not related to the principal activities. Yeah, so not related to the core business. And then we have finance income. This is basically what can be finance income. Any idea? Finance income is, for example, let's say already mentioned dividends received. Yeah, when a company receives dividends, but it's also rental income, for example. Yeah, when a firm rents something out, it's called rental. Or the disposal of asset. When a company gets rid of asset, sells the asset, that's also finance income. Then we have the expenses. Yeah, and the first line here is cost of sales or cost of goods sold. This is the costs that are directly related to the product. Yeah, the costs, actually the costs directly to making the product. Yeah, to the product. R&D expenses. This is that's a question from Ray. Is finance income the government's income? No, this is not. Finance income is income that comes from financial things. For example, dividends. Yeah, if a company receives dividend, if a company receives a dividend from another company, yeah, then that's finance income. If a company received interest, yeah, if a company receives interest, then that's finance income. Okay, cool. We have the R&D expenses. R&D means, you know what R&D means? What R&D stands for? It stands for research and development. Yeah, research and development. Yeah, so some companies, they spend more on research than others. Do you know of any industry that spends more of more money on research? Which is an industry? IT. Yeah, very good. IT is an industry. This is or also healthcare. Yeah, think about pharmaceuticals, companies that produce pharmaceuticals. They also spend a lot on R&D. Yeah, and we have selling, general, and administrative expenses. This is basically, for example, the salary of the CEO. Yeah, the salary of the CEO is not directly related to products. Yeah, but it is administrative expense. Yeah, or general expense. What is also in this category is, for example, marketing costs. Yeah, marketing costs is also SG&A. Yeah, this is sometimes you call that overhead costs because it's overhead. It's not related to a single product. Yeah. Then we have finance costs. What is finance costs, for example? What could be finance costs? This is interest expense. Interest expense. So this is not interest earned, but interest for having loans or having bonds. Yeah, and then we have income tax expense. Yeah, we have a firm has to pay taxes. Yeah, it's called the corporate tax. And what is left after deducting all those expenses is the net income. Okay, I would say here, let's make a second break. Again, 10 minutes. You can grab a coffee, and then in 10 minutes we are back.